Welcome to the MTA Podcast Series, a weekly audio cast featuring interviews with recognized industry professionals. And your host, Ed Carlson.
Election Day, Tuesday, November 3rd, 2009. If the dollar goes to zero, stocks will go to infinity, and everyone will still be broke. The equity market is being propelled by the fumes of burning dollars. Today's guest is Chris Carolan, the recipient of the 1998 Charles H. Dow Award for his paper Autumn Panics, A Calendar Phenomenon, and the author of The Spiral Calendar, a brilliant overview of market timing using the lunar calendar and Fibonacci ratios. Mr. Carolan has written for Barrons and made guest appearances on CNBC. Chris, welcome to the program.
Thank you, Ed. It's great to be here.
Wonderful. Since you mentioned here, you're down in Georgia, I believe. What's the weather like in Georgia this morning?
Oh, it's absolutely beautiful. I mean, it's been a very wet fall, and the drought is over. But right now, we've got a little Indian summer, high 60s, comfortable. Sunset.
Oh, it sounds lovely. Sounds lovely. You know, I was thinking maybe the best way to get started and kind of position you in our listeners' minds, let's start with a real simple question, but one which could be important to a lot of folks listening to you for the first time. Explain the difference between astronomy and astrology.
That's a funny one. I think I'm really motivated by evidence-based phenomenon and what does the evidence in the markets tell us? And people who look at astrology and the planets are here and there, I don't think they have ever been able to make the case that though there is a link, whether it's statistically or empirically or any type of link with market movements. I think for the skeptic who says about anything about lunar cycles or whatever, and they turn their nose up, I think really the place to start is with seasonal cycles, and because seasonal cycles are very accepted. Whether it's various averaging of the year and saying, okay, here are trends that exist. The markets tend to do poorly between May and October. September and October are statistically the worst months. Those seasonal cycles are really calendar phenomenon. I mean, they are linked to the movement of the sun, and even there's data going back. We have commodity data from Babylonian times on clay tablets that shows evidence of panics in October in the 600 BC years. So these aren't necessarily artifacts of our current civil structure or calendar or whatever, but they seem to be long-standing thing. So I think it's a small step once you accept that seasonal type, which are really solar calendar cycles, exist, then to ask, well, what are the other types of calendars that we can look at? And so that's really where my investigations began, was to break out of the strict seasonal thing and say, well, let's look at the moon also. Mm-hmm. And that's where the book, The Spiral Calendar, came in. And then after that, I did work really into eclipse cycles, and I believe that they play a role in things also. But I have nothing to do with the planets, and I just don't think there's any evidence that the planets have anything to do with price movements in markets.
I see. You mentioned eclipses, and you also talking about Babylonians. We're looking long term here. I want to start with discuss the long-term outlook, or at least how you develop your long-term outlook. I know that P.K. Wall, who I believe passed away this year, and David Knox Barker are two of your major influences with their season models of the Kondratiev long wave. And I believe you've mentioned in the past that you believe these eclipse cycles have something to do with this. Can you tell us a little bit about these two men and then describe these seasons for us and how you look at them?
Well, I think what Wall and Knox did, which I think was very interesting, was really frame the Kondratiev long wave and look at it as Spenglerian seasons, if you will, where they broke down the 60-year K wave as being four distinct phases of spring, summer, fall, and winter, and in the spring, and really looking at it in a price standpoint. So spring is mild inflation, and that's good for stocks. Summer is a lot of inflation, that's bad for stocks. Fall is mild disinflation, which is then good for stocks. And then winter is outright deflation, which is bad for stocks. And
now, you're not talking about seasons of the year. You're just using those words.
No, really, just using that as a metaphor for really what can, cycles that can last 10 or 20 years each.
Okay.
And
well,
so,
here's. I'm sorry. We've got limited time, and there's certain points I just have to ask you about. Let's dive right into this. You say that eclipse cycles are the drivers of those cycles. I'm dying to hear more about that.
Well, I mean, what I've noticed in the data is that there is an 8-year that it seems to me that the major turns happen in pairs 8 years apart, so that they're really twin tops and twin bottoms. And so, for example, we had two tops at 29 and 37, 8 years apart, and they were the transition from that fall into the winter. We made also, again, that same thing happened in 1966 and 73. You have two market tops exactly 8 years apart. And then we see it in the market lows, 74 and 82, two bottoms 8 years apart. So when we made a peak in 2000, I called for a second top that would be the twin to the 2000 top that should occur roughly around 2008. It actually came in very late in 2007. So that was an extraordinary forecast based on this model that these peaks occur in gaps of separated by 8 years. And where the 8 years comes from, it's really the difference, 7 to 8 years between 36, which is twice the Eclipse Arrow cycle, and something called the INEX, which is a 29-year cycle that separates successive eclipse cycles, and so that's part of what I've identified the mechanism. So looking further out, what I expect is two major lows, again, separated by 8 years, and I think the first one happens next year in 2010, and then a second twin bottom to that one out in 2018. So that's a long-term look.
I was afraid that your explanation for eclipse cycles wasn't going to be simple. Where would a person go to understand more about Saros and INEX or whatever it was you said?
Actually, NASA has a very good just site with lots of data on it. You can actually find times and details of eclipses, and there are some good books out. That's also really, that's the book I need to write, which is really the sort of the follow-up to the spiral calendar that starts to connect, what work I've done since then. So I haven't done it yet.
And that's a great segue to where I wanted to go next, more of the shorter term, your short term approach, which I believe is the spiral calendar. You've mentioned that the spiral calendar pinpoints turns in the market. Is that correct? What is the spiral calendar?
Well, it's the observation that it's actually the spiral calendar is a set of time units where square roots of Fibonacci numbers are measured in lunar months, and the original observation was that the crash of 1929 and the crash of 1987, the distance between those two crashes is the square root of a Fibonacci number. And then in the book we then find those relationships in all kinds of markets. Since then I've actually been able to show that spiral calendar time units exist in the data in numbers greater than random. So it is statistically significant. And but the difficulty becomes there's also lots of relationships that you can find that really won't work or will steer you down the wrong path. So it's a tool to be used. Ultimately, I think its best value is zeroing in, at extremely emotional times and then allowing you to pinpoint where an extreme peak or a low was. I used it in 2008, really a month ahead of time when it was obvious that the oil market was getting out of control, to then say, okay, now this is the time to find out where the spiral calendar relationships are, and I think we can pinpoint where the crude oil peak will be. And in fact, we got it within a day.
Yes, I noticed that. We're going to continue with Chris Carolan in a moment, but first a reminder that on next week's program we'll have from Miller Tabak Phil Roth as our guest. Let's talk a little bit about your award-winning paper, Autumn Panics, a Calendar Phenomenon. Give us a quick synopsis and tell us what that research tells us about where we are today. Did we escape the autumn panic, or has it just taken a different look this year?
Well, they don't occur every year. I mean, they're relatively rare events, and I think you need a number of conditions, for them to unfold. But the original observation in the book, The Spiral Calendar, which was that here we have these conditions in 29 and 87. And where I took that was in 1997, when the Asian currency panic began to unfold. That was just a classic time to say, here's a panic beginning. We should be able, using the calendar phenomenon and what we know about it, to pinpoint exactly where the climax of the panic will be. And I was able to do that with the Hong Kong bottom in 97. And then it was the write-up of those relationships that became the paper the following year. I see.
What is the solunar model, and did I even pronounce that correctly?
You did. This was something where I was interested, because I felt that the spiral calendar gives you some points that work and but it's not explaining all of the movement in the markets. And this goes to seasonal models. People build seasonal models where they'll average, the yearly trend for the last 20 years and say, we should be, down in October, that type of thing. And I thought, well, if the moon plays a part in things, would we make a better seasonal model if we just average those years that had the lunar phases in sync with our current year? Which would be, 8 years ago, 11 years ago, and 19 years ago, and then repeat that pattern. We get a more perfect seasonal model. And so that's what the lunar model is. It's really just a seasonal model that's been tuned both towards the solar calendar and the lunar calendar. And it's interesting because there are times when the markets will follow it step by step, for the last half of 2008 and the first few months of 2009, the lunar model just was extraordinary in how it tracked, or how the market tracked it. But and then it goes out of phase again, and it doesn't seem to be useful for a while. But I followed it for years, and it's a fascinating approach.
Mm-hmm. Before we end today, I'm going to want to get your outlook on the markets. But before we even go there, let's talk a little bit about Chris Carolan. Can you give us an idea as to how you began your career? Were you always interested in the moon and the stars, so to speak? What were you doing prior to technical analysis?
My education was in fine arts. I have a master in fine arts, which I think just always made me sort of chart-oriented and visually oriented.
What was that? Was that in art itself, music?
Yeah, in fine arts, printmaking specifically, and painting, and then I left art school and got a job on the San Francisco options exchange. Began as a runner, taking tickets out, and then was a floor broker executing orders, and finally a market maker. And so really, so much of my attitude towards markets been influenced by standing in a trading pit and witnessing emotions and witnessing how emotions climax and how emotions hurting behavior, and how everyone will have the same opinion, and then 10 seconds later they've all flipped 180 degrees. It was sort of understanding that there ought to be a cyclic driver to that type of emotional behavior. I think it's a shame that the trading pits really are nearly extinct now, because there are so many economists who if I ruled the world, I think that a requirement to get a PhD in economics would be, you'd have to stand in a trading pit and risk and risk all of your capital, on a one standard deviation move. And if you did that, then the efficient market theory wouldn't exist, because those people would become convinced of its obsolescence.
A year ago, you had mentioned that if gold were to move above 1,040 an ounce, that you would change your forecast of deflation to one of hyperinflation. With gold this morning at 1,080, has that necessarily changed your view? And if so, how does that fit into your seasons model that we're now in? What are we in? Autumn?
We're in winter now. And
winter.
And that the deflation really ought to last until October of 2010, and that's when we ought to see the switch and prices rising. I mean, I think the confusing thing now is we have deflation in an environment of a falling currency. So, gold strength here is I believe in large part due to fear about the dollar and people looking for long term. And once the deflationary forces are finally gone and we make that cycle low next October, then the fact that gold's doing so well now, I mean, you start wondering, well, how many zeros are we going to be adding to the price of it when the cycle actually does turn up? Because now I think it's not inflation yet. It's really it's a weak currency in a deflationary environment.
Mm-hmm.
But once we have a weak currency plus an inflationary environment, it's going to scare everybody, I'm sure.
Well, this bottom that you've mentioned a couple of times that you're expecting in October of 2010, is that the bottom, or is it simply the first bottom to be followed by another bottom 8 years later?
Well, it's a first bottom to be followed by another one 8 years later. But if you look back at we can still then have a tremendous rally off of that, and so I don't know really what path things take and how currencies will distort them in the meantime. So that's tough to say. But this really should be the first of twin lows. I mean, in a sense, it would be like 1974, and then you meet a second low in 1982 before the next big up cycle came. That's the comparison.
Chris, it's been great having you with us today. This is a new topic for most of us. Is there anything else you'd like to mention before we go?
People want more information. I have a blog at Carolan.org, and they can learn more there. And I thank you for the opportunity today.
All right. Well, thank you. And that wraps up today's MTA podcast. From Seattle, I'm Ed Carlson. You can follow me at fatechnicaladvisor.blogspot.com or contact me at fatechnicaladvisor@comcast.net. And don't forget to check out my article in this month's SFO magazine, a new tool for Bollinger Band users. Send us your comments and suggestions. Let's keep our stops tight, people. Good day.